could happen, folks. Anything could happen on a day like today. There's a lot of emotion, a lot of concerns from our viewers. You've all been emailing me, telling me that you're very nervous about what's happening in your portfolios. I want to bring in my good friend Mark Matson, Matson Money founder and CEO. And Mark, with all of this volatility, I know that you say, and you've told me this before on and off camera, that when people start to panic and they get emotional about what they're seeing in the markets, they make their biggest mistakes. Tell me that again right now, and I think the viewers want to hear it as well.
It bears repeating. Look, there's two things that drive most investors. There's instinct and there's emotion. And the instinct is to run away from things that are painful. 30,000 years ago, when you were trying to get away from a saber-toothed tiger, that worked. But it doesn't work when it comes to investing. And the other instinct is to go after things that feel good. So when you see gold at an all-time high and you see stocks down, the average investor wants to sell what's low and buy what's high, which is the exact opposite of what they should be doing. We don't know what happens in the short run, but we know 20 years long-term hold for investment. So we actually have investors calling us and saying, hey, should we be putting more money into our portfolios on this dip? And that's what it is in the short term. It's a dip. Make no mistake about that.
You know, Ken, that's vulture investing. I mean, that is what a lot of investment advisors would tell you to do, is you've got to look for opportunities on sell-off days like today. Companies that do pay decent dividends. Go for your Apples, your GEs.
You're absolutely
right. Yes or no from you?
No, absolutely right. But we have to also recognize that people are afraid. And one of the things I tell people is when it comes to your allocations, if you're not sleeping at night, then you have too much exposure to equities. So just because you can buy an equity cheaper won't help you sleep at night if you feel you have too much exposure.
Okay.
I think what people need to do is recognize that we're not in your father's or grandfather's market. It's pretty much computer driven now. The average trade on New York Stock Exchange, buy to sell, doesn't last for more than 10 seconds. There's now, the news is being digitized and fed right into the mouth of the computer, and the computer is so concerned about the VIX, which is why we follow that, because the more that's volatile, the more computer says there's money to be made here in a short trade. So we're seeing all this volatility because the market is being run by Mr. Spock from Star Trek, that it's all unemotional, where it used to take humans rationalizing, oh, it can't be bad.
Okay, to your point, I want to point my viewers to an intraday chart. If we can get it up, there you go, guys. Thank you so much. Of the Dow Jones Industrials, 10,821. We're now down more than 400 points. We're seeing this again, and Ken is bringing this up. It's program trades. A lot of times when we have certain kicks that these program traders have to make, institutional investors, people that are running your 401k, people that are running your pension, they have to protect you, the folks at home, and that is what they're doing right now. Mark, I just want to bring you into what we're saying this volatility again. The Dow down 418 points. This goes back to, Mark, the fear that our viewers are sensing right now as we're seeing another market sell-off today.
Well, it is fear, and I think that's a good reason that most investors should have a portfolio. Our average investor has about 70% equities, 30% fixed income, and you need some short-term fixed income where you can rebalance and buy the equities while they're low, and you need to be prudent in understanding the volatility. Look, the volatility, though, let's not blame it on short-term trading, because it's always been volatile. There's no increase in standard deviation in the market compared to the Great Depression or 73, 74. Volatility is always there, but that randomness in return is where actually the premiums come from. If it wasn't random and unpredictable in the short term, it wouldn't be a long-term good investment.
Ken?
But the volatility has been there. I agree with that. But now we're seeing it in terms of hundreds of points, not tens of points, the way it was decades ago. And those are big numbers.
Well, as a percentage, it's about the same.
Right, but big numbers freak people out, and they make for good headlines, and that's part of the psychological, I call it the head trash. You have to think in terms of percentages, not numbers, and people will be a lot better off.
Well, Greg has got some ideas about emerging markets, folks, so stick around. We're going to get to that towards the end of the show. Mark Matson, founder and CEO of Matson Money. Mark, thank you very much. It's great to have you on a day like today. He's always